Hello everyone and welcome to Fit Financials. We are here to help you take control of your financial life and become financially fit. In this video, we are going to be talking about the stock market. Specifically, we are going to be looking at some of the alarming signs that the market is giving us and how they are going to affect the market performance. But before we start, don't forget to subscribe, share, and give us a like. It really helps the channel grow, and I would appreciate you even more. Is the second stock market crash imminent? That seems to be the question in every average investor's mind. But before we can give an educated answer, we need to look at how the market has performed and some of the signs indicating an imminent market crash. On a side note, at the end of the video, I will give you 3 stocks that I will be buying into in this market condition. The last couple of weeks have been a roller coaster for the stock market. At the time of this recording, the Dow is at a 0.27% on the green, and the S&P 500 is up 0.34%. Many shares are on the rise, and the Feds, on the other hand, are willing to do anything to support the economy and prevent a meltdown. They are spending trillions of dollars to keep large corporations solvent, send stimulus checks to every American, and give out over $350 billion to small businesses to keep them afloat. There is also a factor that creates excitement among new investors that jump into the stock market the moment they see a company hit record lows. All these factors generate a rally. But let's be clear, a small rally does not mean we are in a bull's market. The truth is that markets are up 22% since the crash at the beginning of the year. Still, the 22% increase does not relate to the economic reality. I will encourage you to ask yourself this question. How can we have 25% uptrend in the market if businesses have not generated profits over the past few months? In addition, we have an economy where over 35 million Americans have filed for unemployment. Airlines are losing money every minute, and government debt is higher than ever before. On one hand, we have a rally of 22% on the market since the crash, and on the other, we have a crashing economy. But the question remains, why is the market moving up? To answer that question, we must understand that the market has a discounting mechanism, which means it considers all available information and reacts to it. The moment we got hit by the pandemic and businesses started to close, the market took under consideration the loss of future profits from the shutdown of the economy and crashed. What it did not take into account was the injection of trillions of dollars in liquidity by the Feds. Consequently, we can say that the market has been moving up based on all the money the Feds are putting back into it. This creates a problem because it prevents the markets from going through its normal corrective cycle. Before the market goes in an uptrend, it must first correct. See, if the Feds wouldn't have put any money into the market, we would still be seeing a downtrend that would correlate with the shutdown of the economy and the unemployment rate. Here is why I think the market is going into a deeper crash in 2020. First, we are not going to have 35 million people currently unemployed step back into a job once this is all over. See, businesses won't be able to keep a full staff as they would also need to adapt to a new norm. Experts are estimating that 1/4 of American restaurants won't reopen. Yes, that's 25% of all American restaurants. Companies like JCPenney, Pier 1 Imports, and Neiman Marcus have already filed for bankruptcy. For instance, in the city where I live, restaurants are starting to reopen, but only at 25% capacity. That also means that only 25% of the labor force they had before the pandemic would have a job. I'm sure we will gradually see more jobs come back, but it will be a slow comeback. And so are the sales and profits of those businesses. Which leads me to the second reason I think we are heading for another market crash. Q2 is coming, and Wall Street has no predictions for it. With the exception of companies who provide services described as essential needs, we will see plenty of companies reporting negative news when it comes to the Q2 financial reports. According to Joel Littman at Forbes, Wall Street analysts seem to be blind to the real impact on earnings we will see in the second quarter. 2020's first quarter earnings were brutal, yet analysts of the most significant investment banks in the world think that the second quarter is due for a substantial rebound. This is not just a case of traditional Wall Street optimism. This time, the analysts are not only directionally wrong in their earnings forecast, but also wrong in the magnitude. Over 90% of the S&P 500 index companies have reported in the first quarter Earnings per share, or EPS, dropped nearly 65% from the first quarter a year earlier, from $35.02 down to about $12.55. With the lockdown only beginning to lift around Memorial Day, most companies will be reporting a minimum of 8 weeks of economic issues in their second quarter. Depending on the industry or geographic footprint, some firms will see a damage to the full 13 weeks. While many management teams have stopped providing guidance, that doesn't eliminate the analyst's responsibilities to deliver the best possible forecast. Analysts and the market may be in for a rude awakening as we approach the second quarter earnings season in mid-July. It appears highly likely that companies will report numbers far below analyst estimates and significantly below the stock market's expectations given the current valuation levels. If the first quarter earnings were bad, imagine what the second quarter will look like. Many economists and market scholars are predicting a recession. Jim Rogers, founder of Quantum Fund, said, quote, "When we have bear markets, and we are going to have bear markets, it will be worse in our lifetime." Alan Greenspan, also a former head of the Fed, said, quote, "There are two bubbles, a stock market bubble and a bonds market bubble." And even Ray Dalio, founder of Bridgewater Associates, sees the closest parallel to the world's current situation as the Great Depression, which he lasted from 1929 well into the 1930s, and is regarded as the worst financial crisis in American history. Dalio sees similarities between rising debt levels in the US and the country's post-Depression era debt. However, with the US set to borrow a record $3 trillion this quarter to aid the economy, the national debt is up to roughly $25 trillion. I don't have such a pessimistic outlook as Ray Dalio has, and I would never bet against the USA when it comes to the economy. Even when I consider myself an optimistic investor, I believe we will see a deeper bottom before we can start recuperating. But even in a crashing market, there is room to make money if we know what companies might be profiting as a byproduct of the situation. Here are some of the companies I will be investing in during this downturn. I currently have a significant position in gaming company Activision Blizzard, and I'm planning to add to it. This company is worth more than $50 billion. In their portfolio of games, they include Call of Duty, Overwatch, and Candy Crush, among many others. Now, with stay-at-home orders in the past couple of weeks, for many states, there is a boom in video game play time. They even raised their full-year outlook even though other companies are cutting or suspending guidance, and it has a new game coming out in 2020. After the March 2020 quarter, it claimed to have 102 million monthly active users for Activision and 32 million monthly users for Blizzard. I have a selling price target for this share of $80. Now, I did buy into this company in the middle of last year when it was trading at around $45. Activision has a net income of $505 million, and that is a 12.98% up year over year. It currently has $5.91 billion in cash on hand and a net profit margin of 28.24%. The second company I see coming out of this crisis stronger is Peloton, ticker code PTON. I just bought a medium-sized position in the company right before I made this video. Now think about it. With many gyms being closed and many celebrities coming out on social media working out from home in the Peloton bike, I think this company will go all the way to $60 per share. Not only that, but they have a fantastic product and an ever-growing customer base estimated at 186 million subscribers. Their revenue increased to $524.5 million, increasing 65% year over year, and their cash on hand is up 116.23%. This is definitely a stock worth looking into. The last stock that I have for you today is PayPal, ticker code PYPL. This company continues to dominate the digital payment space. They saw a surge in new accounts and payment volume as more shopping moves online, resulting in an 11.87% increase in earnings last quarter. They are also investing in peer-to-peer payment capabilities. When you add all this up, we can say that PayPal is a strong buy, at least in my book. My selling price target for this stock is set at $175. If you found value on this video, please subscribe, share, and give us a like. It really helps the channel. And if you have any financial topics you would like us to cover, leave a comment in the comment section below. Make wise choices and keep your finances in check. As always, thank you and have a great rest of your day.